All right, so we are starting, but before we start, just a few things for me to point out before we start with regard to the units. In this unit, you have 3 assignments to do, which you see in unit outline already. But before that, there is some academic integrity training model that also you need to do, which in previous semester, most of you have done. So that should be pretty much straightforward for all of you. But the only thing is, if you didn't do this academic integrity training model, your result at the end will not be visible for you. So your result will be withheld. So if you want to see your result, do it. And I also encourage you to do it as early as possible as you can. And then beside that, we also have engagement activity for this unit. So yeah, it's based on the unit outline. The engagement activity that you do for this unit is based on the unit outline. So if you go through the unit outline, you'll be able to do this activity without any difficulties. And then also to point out about the census date, keep that in mind. So anything you do after the census date might somehow go against you. So have that date in mind. And the first assignment that you do, which is assignment 1, is quiz. That's 20 multiple questions that you would do. And that carries 10 marks and is due on the 9th of July. And then the second assignment is a written essay, which is based on the issues or the topic that we'll discuss during this unit. That is based on the obligations of the chapter and the ship owners. So that carries 20 marks. And then the third one, which is the assignment 3, it's also based on the chapter and the ship owners obligations as well. And that carries 30 marks. So as we go through, if you have any question regarding to those assignments, you are free to ask questions regarding any of these. So that is to say that these 3 assignments, you need to do all of them to be eligible to write the final exam, which is going to be take-home exam that you will do. So let's begin today's model 1, which is under chartering and brokering, but we are looking at the freight market. But just to ask, with chartering and brokering, when we talk about chartering and brokering, what comes to mind? Anybody? Anyone with any idea what chartering and brokering entails or what it might be? It might not be, I'm not looking for perfect definition, but what comes in mind, general, it can be anything.
The contractual relationship between the ship owner and the shipper.
Yeah, that's correct. Yeah, that's true. Any other person?
Our ships are used, bought, and sold.
Yeah, that's true. Yeah, that's also correct. That's also correct. Any other person? Any other person with any idea or any contribution or any understanding of what chartering and brokering entails? So the principles of the principle and practices of chartering and brokering have its root in various areas with regard to ship operations, ship laws, finance, economics, risk management, and history. All these are boiled down to chartering and brokering. And as some of you mentioned, chartering and brokering is just about contractual agreements, negotiation between ship owners and the charterer or the shipper. So whichever form you look at it, it's a negotiation between the parties. The parties can be within 2 parties. It can involve more than 2 parties. But if you look at it, this negotiation is mainly based between the ship owner, which is the ship operator sometimes, or the one having a vessel, and then the charterer who is coming into the market to charter the vessel. But normally these negotiations are not done between the two direct. There is a middleman, or there is a third person involved, which is a broker. So the broker is the middleman between these two parties negotiating the contract between them. And sometimes this negotiation, the broker can be one broker representing the two parties, negotiating between the two parties. And sometimes it can also happen that the ship owner has his broker and the charterer also has his broker, and the two brokers are negotiating the contract for the two parties for their principles. So this contract, when it's negotiated and agreed, that contract becomes what we call the charter party contract. So that is a charter party contract. Now, having said this, the contract is based mostly based on the needs of the charterer, which sometimes can be the shipper or the cargo owner, and then the needs also of the vessel owner or the operator. So when these two parties, their needs are met, then the agreement will be signed, and the contract party, charter party contract will be signed. And then the ship owner will give or release his vessel to the charterer. And to say this, that also comes down to the three focus questions for this Model 1. And in this Model 1, we are looking at the freight market. And so with the freight market, there are questions to ask about the freight market. So someone may ask, what is the freight market? So what the freight market means? Freight means different things to different people. So just to throw to all of you, when somebody talk about freight, or in this context, when we're talking about freight, what comes in mind? What do you have in mind, or what understanding do you have about freight?
Items that are shipped or transported from point A to point B. So that could be anything between loose cargo, bulk cargo, containers, livestock, pretty much anything that could be transported.
Yeah, that's true. Yeah, so that's true. That pretty much any cargo that constitute a freight. And any other person with any idea what freight might also mean to different person? Any other person with any idea what freight might mean to other person? So with Nicholas spoke about the freight the freight being the cargo being transported, so it can be any cargo being transported. And to other people, freight might mean different things to them. So freight to some other people, freight will be the chargeable amount charged for carrying the cargo that we spoke about earlier on. And then to the other people, in our context in this unit for this model that we are talking about, the freight also means the income or the revenue that the ship owners get for releasing or hiring the vessel to other parties. So in our context, that is what we will be looking at more, rather than being the cargo being carried or the chargeable amount charged for carrying a cargo. But rather in this unit, in this model, we are looking at that income that the ship owners generate for releasing their vessel to third party, either charter or the cargo owner or whoever he hired the vessel to. That constitute the freight as well. And that is the main income earning for the ship owners in this unit or under chartering and brokering. The main income for ship owners is coming from releasing their vessel or hiring their vessel to a third party. That is the main income for them. So our focus question, the first focus question for this unit is about what is the freight market and what is its component. So, and the component of the freight market, if you look at it, the third focus question, explain the component or give some indication about the component. So the components of the freight market are the voyage charter, time charter, and then also derivative markets. So those three markets are the components of the freight markets. We'll talk about them. And then the focus question 2 is about what are the major factors that affect the freight market. So at the end of this model 1, we should be able to feel comfortable to answer all these 3 questions. So talking about freight market, we can't just talk about freight market alone without touching on other aspects of the shipping market. So shipping market constitute 4 elements constitute the shipping market, and freight market is just one component of the shipping market. So we can't talk about freight market without looking at the other 3, which are to make the shipping market. So these are the 4 elements that make the shipping market: the freight market, sale and purchase market, shipbuilding market, and the demolition market. So the freight market, as we just indicated previously, each and every market, these 4 markets, they all traded in different commodities. So the commodity that they traded on are different in each and every market, all these 4 markets. However, all these 4 markets has relationship, they link, they have influence on each other, and they intertwine together. So whatever happened in one market affect the other market as well. So let's begin with the freight market. So in the freight market, a ship owner is coming into this market with a ship and looking for a charterer or cargo owner to give his vessel or hire his vessel to the ship, the charterer or the cargo owner. And then a cargo owner or a charterer is also coming into this market, in the freight market, looking for a vessel that he can use to carry his cargo from point A to point B. So when these 2 parties come into the market, they negotiate, and in negotiation, as I mentioned previously, brokers are involved, and the brokers will negotiate between the 2 parties. But from time or before history, for in this freight market, when the ship owners, previously the ship owners, they meet at London in the coffee house. The ship owners are coming there, or the captains are coming there into the coffee house, and then looking for a charterer or a cargo owner who are also coming there. Then the 2 parties meet over there and then transact business, and then a charter party contract is being fixed over there. But in these present days, those kind of meeting in the coffee house is no more there, but rather everything is done online in these days. So a ship owner putting up his ships out there through a broker, and the broker is also looking out for a charterer who is also looking for a ship to carry. Then the 2 parties sign a contract, and then the ship owner has his money, and then the charterer has the ship owner's vessel. And this contract can be different. We'll talk about it as we progress on. Their contract can be different. Now, in the freight market, the ship owners, that is the main income for them. So wherever the ship owner hire these vessels or release these vessels, that is the means by in which they generate revenue to pay off their debt in regard to the loans on their mortgage, the asset, which is the vessel that they are owing, and also all other expenditure they need to take care of. The main chunk of the revenue is coming from the freight market of hiring their vessel, and whatever money they get, that's what they use to settle those debt or any expenditure they have. However, there are other means by in which they also get revenue to pay their debt. So the second mean is through the sales and purchase market, which sometimes we also refer to as a second-hand market. So at a second-hand market, the commodity traded over here is a second-hand vessel. And in this second-hand market, a ship owner coming with his empty ships to sell to another ship owner. So in this market, the money exchange hand from one ship owner to another ship owner. So the money actually didn't go out of the market, the shipping market. The money stayed in the shipping market by exchange hand from one ship owner to another. And the same thing happened to the tonnage of the vessel that we have in the system. The total tonnage in the system doesn't change, but however, the capacity changed from one ship owner to another ship owner, because one ship owner sold his second-hand vessel to another ship owner. So the total quantity in the market still stay the same. If, for example, the overall total capacity in the market is 200,000 DWT or 200 million DWT capacity in the market, when a ship is sold in the second-hand market, the total capacity in the market still stay the same. 200 million DWT, it still stay the same, it doesn't change. But it's only the money that change hand from one ship owner to another ship owner. And then the other market, which is a shipbuilding market. And this market is what we also refer to as a new building. Now, in the new building market, the money flow out of the shipping business, or the money flow out of the ship owners' coffers to a shipyard. So in this market, the money move out of the shipping business to the shipyards, and then the shipyards will build this vessel for the ship owners. Now, in what happened in this market is that whenever a ship is being released on a new ship come into the shipping business, the total capacity increases. So that sometimes may give us whatever surplus or excess capacity in the market, because a new vessels have been added, so the total capacity increase. Now, when a total capacity increase, that also leads us to the fourth market, which is the demolition market or the scrap market. And the scrap market is where a ship is totally taken out of business and it's beached and then destroyed. And then also the ship owners get revenue from this as well. When the ship is being taken into the scrap yard or demolition market and demolished, the ship owners get revenue, which also they use to subsidize or pay some of their expenditure in the market. But the only market that the ship owner doesn't get revenue is in the new building. The money go out of the business and they don't get any money back, but rather they have a new vessel back. But at the secondhand, the demolition market, they get revenue. And at the same time, what happened in the demolition market is when a ship is scrapped or sent to the demolition market, the total capacity in the business reduces. So it decreases. Because the capacity is taken out. Now, that take us to the reason why all this market has relationship, which leads to the shipping cycle or shipping cycle, as you may hear or read in the books. That is starting from the freight market. So when the freight market, the market is doing well, there's enough cargo for the ship owners to hire their vessel or to carry cargo, the freight rate start to increase. And as the freight rate is increasing, the ship owners are, the business is booming, they're making more revenue and more cargo is there to carry. The only means that they can meet the needs of the shippers or the charterers to get a vessel to them on time is going to the secondhand market. Because at the secondhand market, the vessel is there for you to get instantly and start using it for business. So they start going to the secondhand market because the business, the freight market is booming, the income is good, and their charter or the cargo owners need more vessels. So they go to the secondhand market, buy from different segments, buy a vessel from different segments in the market, and then use it for the business. So once that happens, the secondhand market prices also start to increase or grow up or increases because more ship owners want vessel in the secondhand market, immediate vessel to use. And in the secondhand market, ship owners can have this vessel to use for a short period of time. They can't use it for a long period of time because as the market, the freight market is growing and the shippers' needs are also changing. The shippers want specific needs. So the only way to address those specific needs is buying or building a new vessel to meet those needs. And then the new vessels also will be able to meet the long-term future need for the ship owners as well. So second-hand market, up to a point in time, it will be saturated. The price will be so high in the second-hand market that the ship owners will not be able to like to have second-hand vessels because the price is so high and it's also not meeting the exact need that they want. At the same time, the expenditure in running it also is so high because those vessels are old to a certain extent. So they will go to the new building market. In the new building market, they are having a new vessel, but from the time that they place an order and to the time that the vessels are released may take about 2 to 5 years before they have their new vessels. And in between that time, a lot of things can happen. Economy can go into reverse. Other things also can happen. The demand is no more there. And if that happens, a new vessels will be coming in. The capacity is increasing in the market, which means excess supply or oversupply of vessels in the market where the demand is decreasing, not enough charterers are in the market or not enough cargo to carry. And this will start pushing the freight rate down because there are enough ships in the market. So the freight rate will start be decreasing. And as we can see in recent term with recent events like COVID-19, which is also have some impact on this market, the demand drops, new vessels are arriving, excess capacity, freight rate goes down. Now, if freight rate is going down, it will come to a point in time that the ship owner cannot meet their revenue. They can't even break even. So when it reaches that point, the only option for the ship owners is either to lay those vessels up or try to go to second-hand market, try to sell some of the vessels which are bid to the second-hand market. But when the freight rate is down, second-hand market prices are also not good. So you can sell some in the second-hand market, but you not get enough revenue. And at the same time, if you sell in the second-hand market, the total capacity is still the same. So you are still having excess capacity in the system. So the final option for them will be to send some of those vessels to the demolition market or the scrap yard for those vessels to be scrapped off totally. And when those vessels are taken off for scrap or demolition, they generate a revenue, but it also depends on the steel price as at the time, because those scrap vessels, they will be sold to the steel companies for them to use for steel. So if the price as at that time is not good, they may also get revenue, but not good. So this is how the cycle works. So once most ships are being sent to demolition market, then the total capacity also will decrease in the market. And at the same time, economy must start picking up again, or the confidence in hiring a vessel must start again. A lot of people need vessel, then the freight rate will start going up again, and then the cycle started. And the process go in that cycle over and over, and that is what we call this the shipping cycle. And that's how the cycle works. Any questions so far? Anybody has any question? Now, with the few things that we just discussed or I've just spoke about, I want us to look at this question and then discuss this question briefly. So read this question and then let's have a bit of discussion, or probably maybe I'll break you into group for you to have a group discussion. And All right. So yeah, you can have discussion now with regard to the questions that are put on the discussion board just for five minutes, and then the 5 minutes, then will return back to the main classroom.
Hello?
Yeah. So yeah, what are the issues you guys have discussion?
We haven't discussed yet because I didn't manage to write down the question before we left the group and I can't find the question anymore.
Oh, okay. Oh, sorry. Oh, so you're not able to have access to the question.
No, I don't have access to the question anymore.
Sorry. So the first question is about what are the demand factors that have altered the freight market in recent decades. So in recent time, what are some of the demand factors that are influencing the freight market? So having impact on the freight market. And the second one, the second point that I put up over there was the main factors that are also affecting the supply of shipping, the shipping services. So what are the main factors also affecting the supply side? What are the main factors?
Oh, okay.
Yeah.
So things like globalization.
Yeah. That's true.
Oh, yeah, and maybe like the growing exports of China and stuff.
Yeah. That's also true. Yeah. Yeah, that's also true.
Also, would it be, let's see, well, very recently as well, the coronavirus lockdowns would probably have a negative effect on the demand for ships and all that.
Yeah, that's also true. It have negative effect on the demand and at the same time on the supply side as well.
Oh, yeah.
Yeah. And on the supply side, to the other issues that you may also want to look at is also about the competitors. So what the competitors is also doing, if your competitor is also supplying more vessel, then you may think twice not to invest that much in the supply, because if you also introducing a lot of vessel, it's going to be overcapacity in the market.
Ah, yep.
Yeah, so you could look at that as well. Yeah, moving to the different room now. I'll come back to you shortly.
Yep, sure.
Okay.
Yeah, hi everyone. Sorry, some of you couldn't get the question. So did other group? Did everyone have the question? Do you have the point to discuss?
I have a couple that we kind of came up with for each question. Myself, Rohit, and Sarah.
Okay, great. So, any points you want to share?
Okay, so for question one, the demand factors that have altered the freight market in recent decades.
Yeah.
So we've said the economy has definitely impacted or altered the freight market.
Yeah.
As we've recently in 2008 had a global recession.
Yeah.
Then the next point we have put down is freight wars. So more recently, the freight wars between America and China have impacted on the freight market, not only for those two countries, but globally, because they are two countries that are quite high in their exports.
That's true.
And then our third point for that one was increased vessel capacity. So as ships have gotten bigger, things like economy of scales has come into play for the freight market.
Awesome. So on a second point, do you also have some point on that one?
For which one? Oh, for question two, yeah. So
Yeah, the question two. Yeah.
Rohit's got question two. Wherever he is.
Seems not to be.
You there, Rohit?
Oh, yeah, yeah.
Yeah.
So, what affects the supply side of shipping?
Yeah.
I would say the world merchant fleet.
Mm-hmm.
Yeah. So the number of ships in the fleet in the world, and fleet productivity.
Yeah.
The ton miles and stuff, and the world economy as well.
Yeah. GDP. Yeah.
Yeah, all that, and the commodity trades. So with all the industrial demands and the transport policies, and all the, then we've got the ton miles, the haul and ton miles.
Mm-hmm.
Yeah, that's what I've got.
Yeah. Okay. Yeah. So yeah, those are good points. Those are good points. Yeah. Great. Awesome. Any other group also have different points that you want to share?
Yeah, so I was with John and Tristan and Oscar.
Yeah.
And for question one, we kind of had a broader view and said that globalization has been one of the biggest changing factors in the shipping market. And along with that, you had like changing consumer preferences and people wanting more things from different parts of the world.
Yeah.
And so that's just driven trade.
Yeah.
I guess that's all I really got for that part.
Okay.
And like Nicola was saying, changing ship sizes, we had that as another big factor as well.
Okay. Then on the second question, do you have some points on that one too?
I was wondering whether John wanted to do that one because he had a few really good ideas about that.
Yes. So the main factors that constitute the supply of shipping had the just the demand in general was kind of sets what the supply is coming through, and the how those then was it a lot of the ones already said before kind of
Oh, okay.
So yeah, like the number of ships and how the commodities trade kind of sets through. Anyway, but yeah, so demand in general and how that comes through. Anyway, sorry about that.
Yeah. That's true. The demand is a big factor. Yeah, influencing the supply. Yeah, if the demand is not there, definitely it's going to affect the supply. If we already have excess and the demand is not there, it's going to get worse, and ship owners may not even attempt to order a vessel any longer or place order for a vessel for a very long time, which can also have another effect on the entire market. Yeah, so that is true. The other group, any point you want to share which might be a bit different, or you guys also are similar page?
For the first question, the fuel costs would also affect the freight market.
Yep, that's true.
As the supply and demand of fuel will impact the cost of shipping and everything like that.
Yeah. It's also a bigger one. Yeah, it's also one of the biggest factor affecting the freight rates, big time. Yeah.
I'm not sure if people mention government regulations and political events.
There are no, but that is also I think someone mentioned the policy, but that's also a big issue, government regulation. Yeah. But so are you considering that on the demand side or on the supply side?
Could be both, depending upon each nation's or country's regulations, depending upon freight.
Yeah. So on the supply side, the policy will be a big issue with regard to supply side. Yeah. But equally demand to it can also have effects depending on the type of agreement ship owners are having in with other country or the business owners. So that can also be a big factor. Yeah. Do you have any other point apart from those ones?
No, I don't think I think that's pretty much all that group had.
Okay. Yeah. So that's true. Yeah. So with on the supply side, with the policy that you talk about, it's not just about the government policy. One of the big issues is about the bank policy, the policy for the bank. So on the supply side, if the banks are not really ready to loan or give money to ship owners, it will be very difficult for them to supply, even if the demand is there, and then it's not favorable for the bank to loan. It will be very difficult, especially in a time of recession. Most the banks all over the globe tend to take a back seat. They don't want to give loan to ship owners, and which actually have a big effect on the supply of vessels as well. And that is the time some ship owners want to take the risk and also to acquire vessel as much as possible. But the bank policy will not favor you. So you have to find alternative way of finding the money to get a vessel. So that is also a good point that you raised. And in addition to that, the shipyards policy is also another factor with regard to the supply. Sometimes the shipyards also, their policy during a certain period of time, they give a huge discount or provide a favorable condition for building a vessel. So that also can influence the supply side of the ships as well. If those favorable conditions are there, the ship owners will rush to get the vessel at a discount price, good price, favorable condition, having all that they need on their vessel. So which is also good for the ship owners at that time to jump in. Yeah, so all the points that you've all discussed, those are valid and accurate points. So let's look at the freight market. The freight markets have three distinctive elements or components, as I mentioned earlier on during the focus question. So these are voyage market, time charter market, and derivative market, which most of you already are familiar with these markets. So these three markets constitute the freight market. However, these three markets can be broken into two. The first two, the freight market and the time charter market, are what we call the physical markets. Because in I said the freight market, the voyage market, sorry. The voyage market and the time charter market are what we call the fiscal market. In the voyage market, as you probably some of you know, or let me ask, the voyage charter, when we talk about voyage charter, what comes to mind to most of you? I know some of you have treated this already. So the voyage charter, what comes to mind?
It's like a single trip.
Yeah,
Short-term contract.
Yeah, that's correct. Yeah, so just a single trip, single voyage from one point to another point. Yeah, and then the time charter, what also comes to mind in time charter?
It's like I'm going to engage your ship for 6 months of this year or something.
Yeah, so that's also correct. Yeah, engaging the vessel or hiring the vessel for a period of time. So which can be 6 months, as we mentioned, or it can even be 3 months, or a year, 2 years, 3 years, or depending on the number of time that the two parties agree. So in this voyage market and the time charter market, the fiscal ships are brought into this market. So the ship owners are coming into this market with fiscal ship, looking for a cargo to carry or looking for charterer to charter the vessel too. And then also charterers or the cargo owners are also coming into this market with fiscal cargo, with actual cargo, looking for a vessel to carry this cargo for them. So that is the reason why these two markets are what we call the fiscal market. The third market is what we call derivative market. Derivative market is different from the first two, because derivative market is just what we call paper-based market. In this market, there is no any fiscal asset in this market. There's no fiscal ship in this market, and there's no actual cargo to carry in this market. And so this market is just a monetary policy or financial policy that the ship owners and the cargo owners or the charterers are coming together in order to protect themselves. So in this market, they hedge themselves against the adverse swing of the freight rate. So what they are doing in this market is protecting themselves against the freight rate, because as you may know, the freight rate is not stable. It's very volatile. It can be high today, and few months along the line, it can really go low. And as we experienced in just this COVID-19 period, the freight rate does exactly that. So for the ship owners and the charterers or the cargo owners to protect themselves against this, they come into an agreement to hedge the freight, to protect themselves against this swing of the freight rate. So that is what we call derivative market. But we shall talk about this into detail in the subsequent slides to explain more about the derivative market and how it's worked in this context. Let's take a few minutes break, maybe 5 minutes break, and then we continue with the ship employment. Is that okay with everyone?
Yep.
Perfect. So with ship employment, the ship employment, there's two things that happen under the ship employment. So the ship owners, when the ship owners are coming into the freight market and they're coming with empty ships, looking for cargo to carry, we say the ship is open, or it's open for trade. And when they come into the market with the empty ships open, and then they were able to secure a contract, negotiate a contract, and then the contract is being agreed, then we will say that ship is fixed. So that's where future take place. So the ship is fixed. And then that contract that they agree on, that is what we call the charter party, as I explained previously. So in the open market and the fixed, when the vessel come into the market, the ship owner is looking for cargo or charterer to hire the vessel. If the charterer agrees that he's hiring the vessel for a period of time, then the money paid, the charter will pay to the ship owner is what we call the high. And this high is paid per day based on the rate that they have agreed on. And if the ship owner and the charterer also agree that the ship owner is giving the vessel to the charterer for a voyage, for just a single voyage or consecutive voyage, then under that contract, the charterer will pay a ship owner what we call a freight. And this freight is paid per ton or based on the last sum basis. So it will be a dollar figure per ton. So it might be $10 per ton. And then the amount of quantity or the tonnage that the ship is going to carry, it will be multiplied by that dollar figure, $10. So the total amount is what a freight that the charterer will pay to the ship owner. And this also can be agreed on a lump sum basis, not based on the per ton, but agree on a lump sum basis that, okay, for this voyage, I'm paying this amount for carrying the cargo. So that is the main difference between these two. So when they agree on the figure to pay per day for a certain period of time, that is the high. And when the amount that is agreed is a dollar figure per ton for the voyage or certain number of voyage, that is what we call the freight. And so that is the difference between the two, the freight and the high. So when you see the two, you should be able to know that the high go with the time charter and the freight go with the voyage charter. Is that clear? So I have some sample quiz here for you to answer. So as I mentioned in your assignment one, it will be a quiz. So I just put this as a sample, what type of question, the way the form will be, but it's not exactly this question, but just the form of type of question that you will meet. So what would be the right answer for this sample quiz here?
Shipbuilding market.
Yeah. Everybody agree with this? Everybody agree that the shipbuilding market? Yeah. I see the thumbs up. Yeah. So yep. That is correct. Yeah. That is correct answer. Yeah. So the shipping costs, we are going to look at the main type of charter in relating to the shipping costs that they incur. Now, under the charter party, there are three types of the charter party contract. That's a voyage charter, time charter, and then the bareboat charter. And the cost that each and every ship operation will incur, or either the ship owner incur or the charter will incur, or the shipping cost as a whole can be broken into three components also as well. That is the capital cost. Capital cost sometimes we refer to as an overhead cost, so or fixed cost. And this cost will be the deposit or payment of the loan, principal interest that you'll be paying on the loan, or the amount used to acquire the vessel, the asset that you have. Those form the capital cost. And then the second is the operating cost. Operating cost also sometimes being referred to as a running cost. And so this will include costs like the money, the crew costs, insurance, repairs, stores, and maintenance. All those goes into the operating cost. And then the third cost that is the vessel will incur is the voyage cost. And the voyage cost is a cost associated with the actual, when you are undertaking the actual voyage. So fuel, bunker, port dues, sometimes if you're going to use a canal or certain strait, you may be able to, you will be liable to pay these dues. So those components constitute the freight or the voyage cost. And one of the elements also in the voyage cost, which sometimes may vary between the ship owner and the charterer, is also what we call the handling cost, but we'll talk about it briefly. Now, when we take each charter party type contract, so the bareboat, time charter, and then the voyage charter. If you take the voyage charter, all those three components of cost that we have mentioned previously, all those costs will be bought by the ship owner. It will be on account of the ship owner. It's the ship owner who is going to pay all those costs. And then the charterer or the cargo owner is only paying freight to the ship owner. And the reason being that the charterer or the cargo owner is paying freight, and the freight that he's paying cover all those aspects of the shipping costs that the ship owner is going to incur, or the ship owner is going to incur. The only issue that may be a dispute between the two parties is with regard to the handling cost, because the handling cost does not state clearly who should be responsible for the handling cost. The handling cost can be on account of the shipper, and it can also be on account of the ship owner, depending on the charter party contract negotiation that they have when they're signing the contract. So in signing the charter party contract, which is under the void contract, they may include terms in it to make it clear who is responsible for the handling cost. That is a terminal handling cost. So they may include terms like the free in and out basis, and free in and out basis simple will indicate that is the charterer who is responsible for paying those handling charges. And they may also include terms like the line items. If they include line items in the charter party, void charter party contract, it's simple stating that is the ship owner who is going to be responsible for the handling cost. And sometimes also they may include gross load discharge free, and which may clearly state that, okay, the ship owner will be responsible for the loading, and that the charterer will be responsible for discharge. So these are some of the terms that they may incorporate into the void charter party contract to differentiate who is going to pay for the handling charges. But beside handling charges, every other cost is on the account of the ship owner. And then under the time charter contract, the ship owner is responsible for the actual cost or the capital cost, the cost of acquiring the vessel or the interest to pay on the loan is on account of the ship owner. And then the operating cost is also the ship owner who is going to bear the operation cost. That is because the ship owner is responsible in directing the vessel, in commercial management of the vessel, and he is handling the vessel, running the vessel. So therefore, the ship owner is responsible for the capital cost and then the operating cost. And then the void cost, it will be on account of the shipper or the charterer. Simple because now is the charterer under the time charter, is the charterer take responsibility for ordering the vessel, where the vessel should go. So the commercial responsibility is on the account of the charterer. He direct the vessel, where the vessel should go, which port the vessel should go, and where the vessel should load, because he has the cargo and he directs where the vessel should go and load the cargo. So therefore, the voyage costs like fuel costs and the port dues, canal dues, any handling charges, it should be on the account of the charterer, because he is directing the vessel, where the distance that the vessel should cover, which area the vessel should go, and he is responsible for that. So he should be responsible for paying the all the voyage related costs. And then the third one, which is the bareboat, or sometimes they also refer to as a demise charter. And the demise charter, the name bareboat say it, or which stated that the ship is, the bare ship is delivered to the charterer, and the charterer take responsibility of the vessel. And the only cost that the ship owner pay is the capital cost, the cost of investing into the vessel, and the paying of the interest on the loan, that is it. And all other costs like the operating cost, voyage cost, is the charterer who is going to be responsible for it, because the charterer take control of the vessel entirely. The bare vessel, the charterer is going to employ his crew to man the vessel. He's going to take care of the vessel insurance, the cargo insurance, repairs and maintenance. He's going to take care of that. And the bareboat takes a longer form than the time charter. Bareboat sometimes can take the entire lifespan of the vessel. So it can be maybe 10, 15 years, 20 years, or entire lifespan of the vessel. And mostly the bareboat is the financial institution like the bank or some ship investment companies that invest in the vessel, but they don't have any commercial interest in operating the vessel. They don't have any, they don't have any idea to manage the vessel or to run the vessel. That is not their intention. Their intention is to invest in the vessel. So therefore, they will approach a shipping company, or mostly shipping company approach this bank or the investment companies and say, I need a vessel, and then they will build the new vessel and deliver to the charterer, which mostly are the shipping companies. And then they will take on the vessel and run it as their own over time, taking control of the maintenance, insurance, everything. And also the other aspect of bareboat is that those shipping company chartering the vessel under the bareboat, they have intention of owning the vessel or acquiring the vessel in the long run. So they run it, and over time, they will buy the vessel outright and the vessel become their own. And other the bareboat too, the charterers have that free will to put their own name on the vessel, and also to paint the vessel under their own label or logo or whatever. They can use the vessel as their own under the bareboat. So under these three main type of charter party, those are the cost elements associated with it and who is responsible for that. But we shall talk about this into details as we move forward in other models. So now let's look at the voyage charter. Voyage charter can be broken down into three main areas, which is a single voyage, consecutive voyage, and then the contract of affreightment. And in all these, under the voyage charter, the main area or the key important items to look out for is about the lay time. I'll talk about lay time briefly, but let's talk about a single voyage. A single voyage is just a vessel being hired to carry the cargo from one port to another port, period. That is it, under that single voyage. And within that single voyage, when a charterer hired a vessel for that single voyage, the charterer is not under obligation or under pressure to get the vessel from wherever the vessel is moving from to the destination to get the cargo delivered immediately or under that pressure, unless maybe the cargo is seriously needed for certain project within a short time that the charterer will need that cargo to get to the destination as quickly as possible. And also when he gets to the destination, he may be fast to get those cargoes discharged as quickly as possible. The same thing as a port of loading. But mostly these cargo are in a bulk form, in which there's not that time pressure need for them. So when a charterer hired a vessel for a single voyage, the charterer is not under that time pressure. He may use his time at the port of loading being relaxed to load the vessel. And when the vessel gets to the destination, he may also relax to discharge the vessel at his own pace. But on the flip side, the ship owners are under time pressure, because the quickly they get a vessel, discharge the cargo or load the cargo and discharge it, the quickly they can hire the vessel or get into another contract for them to make money. The more the vessel delay, they are losing money. So therefore, a ship owners are under the pressure, but the charterer are not under that serious time pressure. So the ship owners will come into this contract knowing that the charterers are only paying freight, which means it's the ship owner's responsibility to get a vessel from point A to B. But at the loading port and the discharging port, is the charterers are discharging or loading at their own pace. So the ship owner will put a clause into or agreement into the contract that I'm going to give you certain number of days for you to load, for you to use for loading and then offloading when the cargo gets to the destination. And this time period that agree is what we call a lay time. So the ship owner may agree that, okay, I'm giving you 10 days, 10 days in off at the loading port and the discharging port for you to use to offload and discharge the cargo. So however you want to use, if you want to use 5 days at the loading port, 5 days at the discharging port, it's up to you. But in all, I'm giving you 10 days. And if within that 10 days, the charterer exceeded the 10 days, used more than 10 days, maybe in all the charterer used 15 days, maybe 7 days at the loading port and 8 days at the discharging port, then the charterer exceeded 5 days, and on that 5 days, in the contract, the ship owner will charge the charterer for exceeding, and that money that the charterer will be paying the ship owner is what we call demurrage, because the charterer has breached his agreement, exceeded the time that has been agreed upon. And in the same contract, they will also agree in the contract that another money will be paid to the charterer if the charterer used less days than the agreed 10 days. So if the charterer finished, maybe probably they use 7 days in all for loading and discharging, then the charterer finishes 3 days earlier than agreed time. So therefore, the ship owner also have to or pay some money to the charterer for releasing the vessel 3 days earlier. And what the ship owner will pay the charterer is what we call the dispatch. Now, that's about a single voyage. The other voyage is what we call consecutive voyage. Anybody has or heard of consecutive voyage or what consecutive voyage mean? Anyone with consecutive voyage? Anybody have any idea what consecutive voyage means? Is everybody here? Are you all with me?
I'm here, but I don't know.
Oh, okay. That's all right. Yeah.
Yeah.
Thanks. Okay. Yeah. All right. Awesome. Awesome. Yeah.
Is it the contract include more than a single voyage?
Yeah. So yeah, that's correct. Yeah, that's true. So the consecutive voyage is a voyage that entails more than a single voyage. So the vessel will do a number of voyages, so but continuously, consecutively. So that's what we call this voyage, consecutive voyage. So the vessel will deliver and continue in that cycle, continue in that cycle. So more than a single voyage. It can be twice, it can be 3, 4 times, or whatever number of times. But consecutively, that vessel will do the voyage number of times. So that is what we call consecutive voyage. And the consecutive voyage and the contract of affreightment, we sometimes say they are hybrid voyage charters. They are hybrid because they have some element which is common to time charter as well. That is what we call this one hybrid. But apart from consecutive voyage, the contract of affreightment is much more broader or complex than the consecutive voyage. Contract of affreightment is different because in a contract of affreightment, the charterer who has the cargo or the cargo owner come to the ship owner with a cargo and telling the ship owner that I have this tonnage of cargo to move, this big tonnage of cargo to move, and then I want you to carry this cargo for me, but not on consecutive voyage, but to carry it for me within certain period of time. And within that period of time, you would deliver several voyages for me, but it's at your own capacity to use a suitable vessel to deliver this cargo for me. So it's different from consecutive voyage because consecutive voyage is going to be exactly the vessel that agree in the contract is going to be that vessel that will deliver this cargo over time. But at the contract of affreightment, the ship owner has liberty to use different vessels also to deliver, but it have to be suitable vessels. But it doesn't have to be the actual vessel that agree in the contract. So it can vary. And so example would be a mining company or maybe iron ore company who approach a shipping company that I have 200 or 2 million tons of iron ore to move from Australia to China. And I want this cargo to deliver from now in July, but by the end of December, I want all these 2 million tons of cargo to be delivered to a warehouse in China. And the ship owner will agree, yes, I can be able to deliver this for you within the time period from now to December. I can deliver it, and I am able to do that. And then they will agree and sign the contract. And this contract is contract of affreightment. Then the ship owner will make sure he is able to deliver all this cargo for various voyages to the destination before the time elapsed. And the ship owner is able to use different vessels to deliver this cargo to the destination. So that is the reason why contract of affreightment is a bit different than the consecutive voyage. If it was consecutive voyage, it will be the same vessel doing the number of trips for several times. Is that clear, or you have some confusion? Is it clear for everyone?
Yeah, that's good.
Yeah, oh, awesome. Then let's look at a time charter. Time charter is, as we, some of your colleagues mentioned earlier on, is about hiring a vessel for certain period of time, which can be a short period or long period. So it can be a number of months, or it can be year or years, depending on the time that has been agreed. But under the time charter, it can be split into two main time charter. First is a trip charter. So a trip charter is where a vessel is chartered for a single trip, but on a time period. So it's different from voyage charter. The charter coming into the ship owner chartering the vessel for a single trip, but he's chartering it under the time period to have the cargo delivered. And under the time charter, whether trip charter or the period charter, there are key issues or some elements or items that ship owners and the charterer need to take into consideration, especially the charterer have to take into consideration. And this is also relating to your assignment 2 as well. So before the contract is being fixed, the ship owner have to disclose certain issues regarding the vessel that he's coming into the contract with. That is disclosing the performance of the vessel, that this vessel can perform so and so within the, if the vessel is high. First of all, the vessel can do this knot, maybe the vessel can do 18 knots when it's fully loaded. And the vessel consumption is also this. If the vessel is fully loaded, this is how it can consume. And this is also the carry capacity of the vessel. This is how much of tons of cargo that the vessel can load. So when these performances are explained in the contract, when the vessel is actually delivered to the charterer and the charterer is using it, and that the vessel is not meeting all these performances, then the charterer has the right to invoke what we call the off-hire clause. So the off-hire provision will be made in the contract. If the vessel owner said the vessel will do 18 knots, and that the vessel is actually high, is now in operation, and the vessel is only doing 12 knots or 11 knots, which is far below the 18 knots that the ship owner promised. So the charterer has the right to invoke the off-hire clause. And the same thing to the consumption. A ship owner said that my vessel doesn't consume, it consumes so and so, it's fully loaded, and in this weather, this is how fuel it consumes. And you are now operating the vessel during the time charter, and the vessel is consuming more than what the ship owner promised. Again, under certain conditions, you have the right to invoke the off-hire clause. And the same thing to the carry capacity. The ship owner promised the ship can carry maybe 70,000 tons of cargo. And then you also knew that the vessel can carry 70,000 tons of cargo, but in reality, you go to load the cargo, the vessel is able to carry only 40,000 tons or 50,000 tons of cargo. Then you have issue, because as a charterer, the more cargo you carry according to the tonnage that the ship owner described, that will also make you to save money and also to generate more revenue. So in that instance, as a charterer, you can also invoke the off-hire clause. Off-hire simple meaning you stop paying the rent or the hire money to the ship owner, and you are not going to pay the ship owner the high money, because remember, under the time charter, the charterer is paying the ship owner daily rate of hire, and this will be paid either fortnight basis or monthly basis. So under trip, it's just for trip, and the charterer have to take this issue into consideration. The other is the period charter. So the period charter under the time charter is where the vessel is chartered for certain period of time, long period of time, which the charterer can do number of trip under that time charter within the period charter. So these are the two different type of charter you see under the time charter, either the trip charter or the period charter. Any question? All right, I have some quiz here for you, sample quiz here. So is it true or false?
Is it true?
Yeah, you said true? Everyone, any other person with any?
I think this one's false.
Yeah. So any other person? Any point?
I think it's false.
Mm-hmm.
Yeah, I'll go with false. It's false.
Yeah, that's correct. So the correct answer is false. Yeah. So let's look at it. The charter chain. So under the charter chain, it's a bit interesting with regard to what happens if a vessel is being chartered. And under the charter chain, what is important also to know that if we say a charter, that can mean different thing at certain time, and the ship owner also can mean different thing at different time. So let's start with the rear owner. So under a bareboat. So a rear owner, a person who invested in the vessel, built the vessel, and then have the vessel. And that person, the rear owner, may be owner A. That owner A hired the vessel or chartered the vessel under the bareboat to a bareboat charter. And this bareboat charter probably might charter this vessel for 10 years, 15 years, or 20 years, or whatever number of years. Now, this bareboat charter he is the charter, and then the A, which is the real owner, is the owner of the vessel. Now the bareboat charter, because he chartered the vessel for that long period of time, he may not really has the contract to use the vessel for that 15, 10, or 20 years that he chartered the vessel. Because he didn't have a contract, he didn't have a cargo to carry, he's going to look for someone who is ready to charter the vessel under the time charter. And the time charter can charter this vessel also maybe for a time period for 5 years, 2 years, or whatever, 7 years, whatever number of years that the time charter also might charter. So the time charter will be charter C. And then the charter B, who charter from the real owner, charter A, charter B will become a disponent owner to charter C. Simply because charter C now only know the B, charter B, as the owner of the vessel. When he's chartering the vessel from the bareboat charter under the time charter, he only knows the bareboat charter as the owner of the vessel. He doesn't know the real owner, which is the owner A. So C only know B as a owner of the vessel. Therefore, B become what we call disponent owner. He's a disponent owner. He's not actually the real owner, but just that the C doesn't know that he's not a real owner, and the C consider him as an owner, and the C is going to pay his high money to B, and the B also will be paying his high money to A on a daily basis. Now, C, who hired the vessel under the time charter, he hired the vessel, and he also might not have the cargo, so he's go out there looking for people who has the cargo or the charterers who are there to charter the vessel under the voyage charter. So he may charter to them under the voyage charter, or it can also be maybe the cargo owners is chartering the vessel to under the voyage charter. And then the voyage charter, which is D, in that time also know C, charter C as an owner. And he doesn't know the vessel charter C also charter that vessel from B, who also charter from A. He only D at charter D only know charter C, the time charter owner, as the owner of the vessel. And he is due to pay what we call freight to the charter C, which is the time charter owner, because he's now engaging in voyage charter. Hire the vessel is hired for him to from one point to another point, one port to another port. So he's only paying the charter C a voyage charter. So in that sense, charter D only know charter C as an owner, but charter C actually is just a time charter owner, and charter C also know B as a owner who is a disponent owner, and the B also know the B actually know the real owner. Now, in this case, a charter to someone is now an owner. That owner is also a charter to someone. So when we say a charter, it might mean charter to someone, or under certain condition, it might mean charter, and under certain condition, it might also mean the owner, the ship owner. And the same thing, the charter sometimes can also be a cargo owner, or it may not be a cargo owner, it's a charter who hiring the vessel to also use to carry cargo for another person. So in this charter chain, all that you have to really know that can, for example, can B, charter B, who is a disponent owner, approach D to pay him the high money, should in case maybe C, charter C, who is responsible for paying B, is not paying B. Can B approach D, or can A approach D and saying, oh, the vessel is my own, B is not paying me, so therefore I need to claim for the money that B is not paying me. We shall discuss this into details in our subsequent models. So over in this content in model 1, we'll not cover that aspect. We'll cover that aspect in the subsequent model 5. Any questions so far regarding this charter chain? Any question? Okay, it seems it's okay. Yeah, I have another quiz question here for you. Which is the correct answer here?
Is it the real owner?
Yeah, I'd say real owner as well.
Okay. Any other person also with?
I would say that the shipmaster is instructed by the charterer, because the charterer is going to tell the shipmaster where and what they're taking and where they're going.
Okay. Yeah. Any other person having a different point? Yeah. So the correct answer is a charterer. So the charterer, because under the time charter, the charterer hired the vessel for a period of time, and he take control the commercial responsibility of the vessel. So he direct, as you mentioned, that's true. He direct the vessel where the vessel should go, which cargo the vessel should load, which port it should go. So he is now giving instruction to the shipmaster. Even though the shipmaster is responsible for the rear owner, the shipmaster belongs to the rear owner. Is the rear owner that employ the ship owner, the shipmaster, and he is paying him salary. But under time charter, the shipmaster is taking instruction from the charterer. Is the charterer who is now taking commercial responsibility, directing that the vessel should go to maybe Brisbane Port. From Brisbane Port, she should go to Townsville. From Townsville, it should head to Fremantle Port. So wherever that he is directing the vessel, he has a cargo, and he has a control over the commercial operation of the vessel. So therefore, he is giving instruction to the shipmaster, and the shipmaster have to listen to him. Even though the shipmaster may also be listening to his employer, who is the real owner, but at that time, under the time charter, he's taking instruction from the time charter. And there are conflicting issues that can arise in that instant, but we shall talk about that later in different model, because the shipmaster is employed by the real owner, but he is taking instruction now from the charterer. And if that instruction conflicting, his real owner's also instruction that he's giving to him before the ship is engaged in operation, there are some issues that may arise in that instance. So we shall discuss those issues later. But in this context, the correct answer is charterer. Yeah, that's true. I have another one here for you. Which one is the correct answer here?
Is it none, because don't they just pay the capital costs?
Yeah, so you go for none of above. Yeah, any other person?
I'll go with the capital cost as well, none of above.
Okay, none of above. Yeah.
I'm going to say none of the above as well.
Yeah. Okay. Yeah. So it's everyone who joined for none of above. Yeah, that's correct. So that's the correct answer. all those above costs are not on account of the ship owner under the demise charter. So yeah, that's the correct answer. Because the crew cost will be brought by the bareboat charter, but not the rear owner. The rear owner will not be paying that money because he's giving the vessel barely to the charterer, and the charterer take responsibility, ownership of the vessel. The charterer is going to hire his crew, maintenance, insurance, port due, bunkers, everything is on the charterer's account. The ship owners will only be, it's just the interest on his loan. That might be the only thing he have to worry about. That is it. Awesome, that's good. Yeah, so let's continue up. Do you want us to take another 5-minute break? Then we continue. Is that okay with everyone? We take a 5-minute break or we continue? Is a 5-minute break okay with everyone or we should continue?
I don't mind.
I'm happy, whatever.
No, okay. So then let's continue. So we are looking at the freight rate risk management. So ship owners, when they acquire vessel or they have a vessel in their possession, they have a risk to manage because the freight rate is very volatile. It's not stable. So that risk is really high, and the management of the ship themselves for them is a very high risk for them to manage. So therefore, the ship owners basically have 3 options to utilize. The first option for the ship owners to kind of protect themselves from these risks or try to manage this risk is for them to just hire the vessel under the time charter. Look for charter and then hire the vessel for the charter, maybe five years or 7 years or 10 years, whatever years, or maybe 2 years, whatever years that the ship owner might deem fit for him based on his own prediction and thought of the future. He might hire the vessel under the time charter as an option for him to minimize the risk. Because once he hired the vessel under the time charter, his daily earning, daily high is guaranteed for him for that number of years that the vessel is being hired. So if the vessel is hired for maybe 3 years, he is fully assured that the high money has been agreed from day one. That high money is being going to pay for him. So that 3 years expire or 5 years, whatever years expire. And he's taken into consideration in hiring under this time charter that he's able to pay all his loans or the interest on loan and also other expenditure that he needs to pay, administration costs, managing his company, and also paying crew on other employees. He take all those into consideration and making sure that, okay, he's able to break even and also maybe make some profit on it, and then he hired a vessel. So he's fully assured that he's covered, his risks are protected. The downside of that is that he is not going to take advantage of the shipping boom if the boom arrives. So if the freight rate, all of a sudden the freight rates started shooting up or shoot up, he can't take advantage of that because his vessel now is in control, is in possession of somebody who is using the vessel, and is that charterer who has the vessel now would take advantage of that boom in the shipping business. So therefore, he invested in a business, all right, he invested in a vessel, but somebody is making a huge profit out of his vessel, and he can make that profit. On the flip side, is also correct that if the freight rates drop down, instead of if the vessel were to be with him, he's going to lose, not break even. He's not assured, guaranteed that he's not going to lose because he has his constant income or daily high, his earnings. So therefore, he's protected on that side. but taking this time charter option will be option that some ship owners will consider that playing safe by not taking advantage of the future boom that will arrive. And ship owners will take a lot of things into consideration based on their prediction of how the market will go in future, or how the freight rate will go, direction that the freight rate will go in future. They will take all these into consideration before using that option, the first option of time charter option. The second option that the ship owners will choose is by going into the fixed spot market, by protecting themselves, by hedging themselves against the freight rate. So that is using a derivative contract. We shall talk about derivative contract in the next slide. But so derivative contract is the ship owner is entering the market or about protecting himself, that should in case the freight rate is down, he somehow protect so that he will not lose that much in that instance. So he's protecting himself from that. And the third option for the ship owner to take is to take the risk and be bold that I'm going to the market into the fixed spot. So I'm going into the spot market and the ship will be in my possession. Whatever that the market offer, I'm going to take it. And this is a risky and bold decision to take, because the ship, you can go into the market, and as we witnessed with a recent issue with COVID-19, you have your vessel, all right, but then with this issue, and you are not earning income as how you should earn, let alone to break even, and it's going to have serious effect on you. And at the same time, you can have your vessel, then all of a sudden the freight rate will start increasing exponentially, and then you're going to make a lot of profit as well. So the third option is the last option to take, and it's a bold option also to take, to have the vessel with you to go into the spot market anytime and then trade it in the spot market. So these are the three main strategy or the means in which the ship owners can use to manage the freight rate risk or somehow mitigate the freight rate risk. So now let's talk about the freight derivative market. The freight derivative market or the freight derivative contracts are, as I said previously, is just a way of hedging the freight rate against the adverse swing or the movement of the freight rate. Mostly there are various freight rates to use, but mostly the common one used is a FFA, which is a Foul Freight Agreement. So the Foul Freight Agreement work in this way. A ship owner is in a market, has his vessel, and then a charterer who has a cargo approaching the ship owner and saying, I want to hire your vessel, but I want to fix it under this rate. So that means the charterer, before the charterer come into the market, the charterer is observing how the freight rate is working. Now, the derivative market, the way it works, is simple based because as a charterer, you know that you have a cargo, and that cargo, it will be delivered, or that cargo will be loaded on certain date in future. So for example, maybe we are in July, and the charterer knows that his cargo will be available somewhere in December, or maybe because of the seasonal production of the cargo, maybe it's a grain product, and the cargo will be available in December, and that is where he will have the full cargo to move. The charterer will approach a ship owner now, because the charterer will not like to wait till December before going out there into the market to look for a vessel to carry the cargo. December, he may move into the market and there's no ship around because every ship is fully occupied, busy carrying cargo. So you will not have a vessel at that point to load. So the charterer will approach the ship owners in advance, maybe this month, and try to sign the contract for December, that during December that will have this vessel to carry the cargo for me. But the ship owners will not be able to willing to sign the contract now, knowing that, okay, December, the prediction might be the freight rates will go up. So the ship owner will not be willing to sign the contract now based on the current rate that, okay, yeah, you have my vessel in December, the vessel is trading now somewhere, December you have it, but based on today's rate. Now, the ship owners, based on their prediction, the ship owner will say, by December, I'm pretty much sure the freight rate, probably maybe the freight rate per ton today is $18. And this month, the freight rate is $18. And based on the ship owner's prediction and how the freight rate is moving, he may think that by December, the freight rate might be around $30. So if the freight rate is going to be around $30, why should I give you a contract now, sign a contract with you saying, I'm going to give the vessel to you in December, $18? No, I can't do that. I can only sign a contract now based on $30. And then the charterer or the cargo owner also will not agree that, yeah, the freight rate might seem that it's going that way, but I'm pretty much sure by December, the freight rate may not reach that far, or the freight rate might even drop. So the charterer will also say, I can't sign today based that the freight rate will be $30. So therefore, before the charterer comes into the market negotiating, the charterer already look at the freight direction, how the freight rate is doing. So the charterer will come, all right, I know the freight rate is doing this, so therefore, let's peg the freight rate that by December, the freight rate will be around $22 or $22.5 per ton. So therefore, let's sign the contract now against December, that in December, $22. And then the ship owner also will agree that, okay, then this will be our freight derivative contract, that in December, the freight rate we are signing now will be 22.5. But if around December, the freight rate jumped to $30, then the ship owner actually is supposed to receive $30, and the charterer will pay $30, but the ship owner have to compensate the charterer 7.5 for the freight, actual freight rate to reach $22 that they have agreed now. And in the other direction too, if the freight rate drop further below today's rate, which is $18, maybe the freight rate drop further to somewhere maybe $12 or $10, then the charterer also have to compensate the ship owner, pay the difference that dropped from $22 that they have agreed to reach in future. The charterer also have to pay that difference of that money to the ship owner. So this is how the freight derivatives work. It just works like, okay, if you take simple example, it's like betting. If we are betting on some game and we all agree, maybe we bet 1 million each, that if you win, you take the 1 million, that means you get 2 million. And if I win, I take your 1 million, I also make 2 million. It's that is simple as that, but we can come into the derivative contract in this term with the power freight agreement that, okay, if we bet now 1 million, if you win, that means instead of having the 2 million, you pay me 500,000. So instead of you having 2 million, you have 1 million to make 2 million, you are paying me 500,000. So in all, you're going to have 1.5 million, and then give me 500,000. In the same way, if I also win, instead of me having the 2 million or the 2 million with me, I'm going to compensate you by paying you 500 million. So that is how the derivative contract works. So it's in a nutshell, it's not a win-win situation, but you are somehow protecting that you will not lose everything. You are not going to lose everything. At least you are protecting yourself that you will gain something out of it. So no matter how direction it goes, somebody may win to some extent, but it's not taking everything off. You are also gaining something. So you are, some people may say win-win, but it does not win-win. You are losing, but you're not losing everything. Is that explanation right? I think I've spoken for long on that one, but is that clear for everyone? Awesome. Thanks. Now, with derivative contracts, before a charterer and a ship owner engage in a derivative contract have three main components or three main key issues that you have to take into consideration. The first one that the both parties will take into consideration is about the reliability of the freight index. So that's how the freight index come in here. So the both parties will not sign the contract if there is no freight index. The freight index is just a composition of various freight rates that a reliable organization they compute and run them to clearly show the direction in which the freight rate is doing. And mostly this is done by the Baltic Exchange. And this organization is independent organization, and they collect data or the freight high or the charter rate from brokers all over the world, and then collect it from them and compute them from several routes. They combine several routes together to run them to come out clearly with the indices. So for the freight derivative contract to go ahead, one of the components is that you need to have reliable indices. And that is because if you don't have reliable indices, you try to negotiate based on some indices which somebody can influence, you will be at lose at the end. And the best way is to use the independent organization that bring out these freight indices. So as I mentioned, Baltic Exchange and other independent organizations are there, because this independent organization, no individual company will be able to influence them. Ship owners will not be able to influence them, and the charterers also will not be able to influence them, though in certain circumstances, yes, ship owners might try to influence them, but the independent organization, they know that their integrity lies on them giving the reliable indices, because if your integrity is lost or somebody or the industry come to realization that you are bringing indices based on some shipping company's influence or any charter's influence, your business is lost forever. You can't get any reliability again. Nobody will use your indices. So these independent organizations are the best way to get the reliable indices. Apart from the reliable indices, the second factor also need to be considered with derivative contract is making sure that there is enough liquidity in the market. And this means that the contract, there should be enough liquidity that the contract can be signed within a short period of time. So the contract will not cannot stay there for long, because if the contract is not signed for within the short time, based on the trust, then the value or the essence of that the freight derivative is lost. So that quick liquid enough need to be there. And then the third option is the credit risk. Credit risk need to be considered in a sense that credit risk, for example, maybe a time charter can lose the vessel. So you are signing a contract with a time charter who is saying, December, I'll deliver the vessel for you. But if that time charter defaults payment for the original charter that the owner that he is hiring the vessel for, the owner might take the vessel off from that time charter. Now you have signed contract, but the vessel is that time charter don't have the vessel any longer because he's not able to pay his hire to the rear owner. So therefore, that risk is also there, and it needs to be managed thoroughly, that you can have the vessel at that time that you want to hire the vessel. So the indices need to be reliable, and these are some of the indices that you will see in the news. Mostly these indices are being published, and they come in the form of daily news or reports, or sometimes weekly, and also it's also come in the form of magazines. Some magazines publish all these, but the reliable ways is to use the Baltic Exchange or Lloyd's list, and you have access to this, or you can use this Lloyd list or the Baltic Exchange to get some of these indices to see how these indices work. And so the indices are in the dry setup and then the box set as the liquid box setup. So the indices you can see on the screen over here are for both dry box setup and the liquid box. The one on top is for the liquid dry bulk, and the bottom one are for the liquid bulk. So the BCI is the Baltic Exchange Cape Size Index. So that is the BCI, and then the BPI is the Baltic Exchange for Panama Index, and then the BSI is the Baltic Exchange for Supramax Index. And then you go to the liquid bulk, which are the BDTI and then the BCTI. The BDTI is the Baltic Exchange Dirty Tanker Index, and then the BDTI is the Baltic Exchange Clean Tanker Index. So these indices, we'll talk about these indices into details also in the subsequent models as well. So don't worry too much about it. To our final slides for today's model is about how these indices is being computed and how to run them. So I just put example over here with how these indices are being run. They consolidate or group combine several routes together per type of cargo, type of vessel, certain routes, and they combine them together to run these indices. And we'll also look about these into details. But I just put this one over here on the slides for you to say. Yeah, so the final point about the freight derivative, how freight derivative work, we have two forms of how freight derivative work. The first is what we call the OTC, or over-the-counter offer, or the swap offer. Over-the-counter offer, OTC, is in a form that two principals, which is the ship owner and the charterer, they come together to engage in a freight derivative contract with a broker in between negotiating these contracts for them. So the charterer coming into freight derivative through his broker and giving all his details, how much he want to pay and everything to the broker, and the broker is approaching the ship owner, and the ship owner, the broker bringing them together, they agree, and then the freight derivative contract is signed. So that is over the counter offer or the swap offer. Now, there are some disadvantages to this offer. The disadvantage to this offer is that you have a risk of losing, you have a risk of losing in under this contract, because if you sign this contract, is between the ship owner and the charterer. If one party defaults, there's nowhere you can go to claim your money. So the risk is on you. For example, maybe the contract is being signed between the ship owner and the charterer, and then the charterer defaults. The ship owner has nowhere to go if the charterer is not capable of paying. So the ship owner will have to take that risk. The risk is on the ship owner. And then the second type of the freight derivative is what we call the futures. The futures is being traded or is organized by the exchange guarantee clearing houses. So there is a clearing house that stands in, or the contract is being featured through a clearing house. So the clearing house is there to sign these contracts. So whoever under these futures, whoever default, the clearing house is there to pay on behalf of that person. So this is the standard and the most appropriate one. Most ship owners and the charterers will use using the clearinghouse. There are various clearinghouses that clear these features. So we have clearinghouses London, Oslo, UK, Hong Kong, Japan, all over New York. These clearinghouses are there, which stand in. So you have the clearinghouses, the derivative contract go through this clearinghouse, and then you know that you are protected. If one party default, the clearinghouse is there to to settle you no matter what happened. So that is the difference between these two freight derivative contracts, the over-the-counter offer and then the futures. Any question? Any question? So that is our final point over there, and I also have a quiz here for you for the last one.